With a market cap that seems to defy gravity, sitting at over $4 trillion, and a stock chart that looks more like a rocket launch than a financial instrument, Nvidia has become the undeniable center of the investing universe. For months, every conversation has revolved around one question. Is this real? Or is it the biggest bubble since the dot-com crash? Well, with its latest earnings report, Nvidia didn't just meet expectations, it shattered them, posting numbers so powerful they seem to make a mockery of any bubble talk. With a reported $57 billion in quarterly revenue, up a massive 62% from a year ago, and a staggering backlog of orders that has CEO Jensen Huang saying they are sold out, Nvidia just made a powerful case that the AI boom is built on solid ground. But what if the market is ignoring flashing red lights? From an intense concentration of its biggest clients to a circular flow of cash that some critics argue could be artificially inflating demand, the ghost of bubbles past is still very much in the room. Nvidia's numbers look unstoppable, but are we ignoring the warning signs? In this video, we're going to break down both sides of the argument, using the latest data to figure out what's really going on. To understand the bull case for Nvidia, you have to start with the numbers because, frankly, they are staggering. The company recently announced its financial results for the third quarter of fiscal 2026, and the figures are almost hard to comprehend. They reported record revenue of $57 billion, a 62% increase year over year. The engine driving this unprecedented growth is, of course, the data center division. This segment, which houses the AI chips that have become the world's most sought-after commodity, brought in a record $51.2 billion for the quarter. That represents a 66% surge from the same quarter last year. CEO Jensen Huang's commentary on these results was anything but timid. He stated that sales of the new Blackwell platform are off the charts and that cloud GPUs are completely sold out. This isn't just corporate cheerleading. It's a reflection of a fundamental reality. The demand for generative AI and accelerated computing is not just growing, it's compounding. This is what Huang calls the virtuous cycle of AI. As models become more powerful, they require more computational power, which in turn enables the creation of even more sophisticated models. This intense demand is solidified in what might be the most powerful part of the bull thesis, Nvidia's order backlog. While the company doesn't publish an official backlog figure, analysts have cited a colossal order book, with some reports mentioning chip orders totaling around $500 billion for 2025 and 2026 combined. This backlog reportedly includes orders for the current Blackwell architecture as well as the next generation Rubin platform. A backlog of this magnitude provides a level of revenue visibility that investors usually only dream of. It suggests that the world's largest technology companies are not just experimenting with AI, they are committing massive, multi-year capital expenditures to build out their infrastructure, and they are overwhelmingly choosing Nvidia to do it. This leads us to Nvidia's deepest competitive advantage, its impenetrable moat, the CUDA software ecosystem. For nearly 2 decades, Nvidia has been building CUDA, a parallel computing platform and programming model that allows developers to harness the power of its GPUs. It has become the undisputed industry standard for AI development. For a competitor, building a GPU that is merely faster or cheaper is not enough. They would have to convince the entire world of AI development to abandon 2 decades of accumulated knowledge, code, and optimization. This software lock-in gives Nvidia immense pricing power and is a key reason its market share in AI accelerators is estimated to be over 80%. The product roadmap only strengthens this position. The new Blackwell platform is ramping up in volume, delivering what Nvidia claims are order of magnitude performance improvements for AI. And beyond Blackwell, the Rubin platform is already on the horizon. This relentless pace of innovation keeps competitors constantly on the back foot, trying to catch up to a target that is always moving forward. Finally, Wall Street has largely bought into this narrative. Despite the stock's incredible run, the consensus among dozens of analysts remains overwhelmingly a strong buy. Average price targets sit around $258, with some of the most bullish analysts setting targets as high as $352. The bulls argue that when you look at Nvidia's forward price to earnings ratio against this backdrop of explosive growth, the valuation, while high, is not just reasonable, it's justified. But despite the incredible numbers, there are red flags that are hard to ignore. For every analyst calling for a new paradigm, there's a skeptic whispering about the dot-com bubble. And the bear case against Nvidia isn't just a vague fear. It's built on specific, quantifiable risks. The first and most cited concern is valuation and historical parallels. With a market cap soaring past $4 trillion, Nvidia has entered territory occupied by only a handful of companies in history. Bears draw a direct line from Nvidia today to Cisco Systems in the year 2000. During the dot-com bubble, Cisco was the Nvidia of its day, making the essential picks and shovels for the internet. Its stock soared, its market cap peaked at over $500 billion, and it traded at a price-to-earnings ratio of over 200. We all know how that story ended. When the bubble burst, Cisco stock cratered. The bears argue that today's narrative about the AI revolution sounds eerily similar. The stock's current PE ratio might seem more reasonable, but it still prices in years of flawless execution, a dangerous assumption in the notoriously cyclical semiconductor industry. The second major risk is customer concentration. Nvidia's astronomical data center revenue isn't coming from thousands of small customers. It's overwhelmingly driven by a very small number of hyperscale cloud providers. In a recent filing, the company revealed just how concentrated this is, with 2 direct customers accounting for nearly 40% of revenue in a single quarter. All told, it's estimated that a small handful of large buyers make up well over half of the data center business. This creates a significant vulnerability. These hyperscalers are not just Nvidia's biggest customers, they are also its most motivated competitors, with companies like Google and Amazon actively developing their own AI chips to reduce costs and dependency. This leads to a more complex argument, the theory of circular investments. Skeptics point to a potentially self-fueling loop of money that might be inflating demand. The dynamic works like this. Nvidia, through its venture arm, invests in promising AI startups. The most prominent example is its relationship with CoreWeave, a specialized AI cloud provider in which Nvidia is a key investor. CoreWeave, in turn, uses its capital to buy billions of dollars worth of Nvidia's GPUs. This relationship has become even more intertwined. In a multi-billion-dollar deal, Nvidia agreed to purchase cloud capacity from CoreWeave if it goes unsold, providing a kind of revenue safety net for one of its own major customers. Bears argue this creates an artificial ecosystem. Is the demand for GPUs entirely organic, or is some of it being fueled by financial commitments flowing from Nvidia itself? Finally, there are the unavoidable macro and geopolitical risks. The tension between the US and China remains a persistent threat. While the US government recently approved the conditional export of Nvidia's H200 chips to China, the policy is complex and requires US government approval for specific customers. There is no guarantee that Chinese companies will rush to buy these chips, with some reports suggesting they may prefer to focus on developing their domestic industry. Given that China was once a massive market for Nvidia, this continued friction represents a significant cap on its growth and a source of ongoing volatility. So, where does that leave us? On one hand, you have a company posting growth numbers that are simply without precedent for an entity of its size, backed by a technological moat and a backlog that suggests this party is just getting started. On the other, you have alarming historical parallels, legitimate concerns about customer concentration, and a complex web of investments that could be artificially juicing demand. So, did Nvidia just disprove the AI bubble? The honest answer is that it both proved the bull case and validated the bear case at the same time. Here is my take. The comparison to Cisco during the dot-com bubble, while a powerful narrative, is fundamentally flawed in one critical aspect: profitability. Many of the dot-com darlings were burning cash. Nvidia, by contrast, is a profit machine of epic proportions, boasting GAAP gross margins in the mid 70% range. In its most recent quarter, it posted a net income of nearly $32 billion. This isn't speculative valuation. It's backed by tangible, massive cash flows. The demand is real. However, that does not mean the risks aren't real. To me, the most significant risk is that customer concentration. The fate of a $4 trillion company resting on the spending decisions of a few other companies is a precarious position, no matter how strong the current demand is. The hyperscalers will inevitably continue to pursue their own silicon, and any diversification on their part will act as a headwind. The circular investment argument is also valid, but perhaps overblown. While the optics of investing in your customers who then buy your product are not great, it's also a strategic move to accelerate the ecosystem. By funding startups like CoreWeave, Nvidia helps ensure that there are platforms available to put its GPUs to use, creating a broader market for everyone. It's a high-risk, high-reward strategy that cements their central role. Ultimately, I believe Nvidia's valuation is not so much a bubble as it is a measure of extreme confidence. The market is pricing the stock as if the AI revolution will continue unabated, that Nvidia will maintain its technological leadership, and that its major customers will remain dependent for years to come. If you believe all of those things, then the stock could still have room to run. But it also means the margin for error is razor thin. Any hiccup, a delayed product, a competitive breakthrough, a sharp turn in the economy, could lead to a brutal and swift correction. In the end, whether Nvidia is in a bubble depends on your time horizon and your belief in the transformative power of AI. The bulls see a company at the dawn of a new industrial revolution, with earnings that will eventually grow into its massive valuation. The bears see a cyclical semiconductor company at a peak valuation, facing inevitable headwinds from competition and market saturation. The Q3 earnings report didn't end the debate. It just raised the stakes. The numbers prove that the demand right now is very, very real. But they do not guarantee that this level of growth can continue forever. The story of Nvidia is no longer about whether AI is a real trend. We know it is. The story is now about execution, competition, and valuation. The fundamentals are undeniably incredible, but the risks are equally stark. This is the tightrope that Nvidia and its investors must now walk. But that's just my analysis. I'm genuinely curious to know what you think. Is this a once-in-a-generation buying opportunity, or is it 1999 all over again? Are you buying, selling, or holding Nvidia stock right now? Let me know your thoughts and your price targets in the comments section below. Your perspectives are a huge part of this conversation. And if you found this deep dive helpful and want more balanced analysis on the stocks and trends shaping our market, make sure you hit that subscribe button and turn on notifications so you don't miss the next video. Thank you for watching.